Well, hello and welcome back to another edition of Hawk's Scan Sentry Report. As always, I am Hawk Arps, Vice President of Jan Arps Traders Toolbox, where you will find the best technical analysis tools on the market for the markets. Well, today I'm interested in taking a look at the American indexes and seeing if we can figure out what the status of the stock market is, and perhaps at the end we'll even identify a few tradable stocks. So let's get right to it and see what the Scan Sentry toolkit is showing us about the strength of the various indexes and sectors relative to the SPY. Once again, looking at the Scan Sentry toolkit on the eSignal watch list, you can see that I have set up a series of synthetic symbols, each an ETF relative to the SPY. So using these synthetic symbols, I can identify which indexes are strong or weak relative to the SPY, which sectors here might be strong or weak relative to the SPY, which ones are strengthening and weakening. Some other common ETFs that have significant relationships to the SPY, like treasury bonds, short-term bonds, corporate bonds, junk bonds, gold, oil, the dollar, etc. And you can see that I've got a lot of our indicators from the Scan Sentry toolkit applied to these synthetic symbols. Here you can see the triple trender showing us the state of the triple trender for each of these synthetic symbols. Here you can see radar 3. Here's the radar 3 value. Here's how many bars ago it crossed zero and how much it has changed, percent change since that time. Here's an overbought, oversold trend exhaustion 1 indicator for these synthetic symbols. And here you can see the fear greed. And I put it on there twice. The second case I use bounded so that it normalizes the values so I can actually see how strong or weak the buying and selling is in a normalized manner. And then here's the trend exhaustion 1, this time just using a fast slow cross so I can see if something is ready to flip. And I just want to show you real quickly what I see when I look at this. When I compare the Dow, the Russell, and the NASDAQ to the S&P, which is the SPY, I can see quickly by looking at the triple trender that the Russell is actually stronger than any of them and has been for a while. You can see it's got a score of 6, where following closely behind that is the NASDAQ with a score of 5. Recently, just on this last bar, moved up to 5 from its previous score. And then the Dow is a little bit weaker. In fact, you can even see that its radar 3 value is in the negative numbers. So we'll look at the charts in minutes, but we can see that the Russell is the strongest of the 3 indexes right now. It's got positive fear greed, positive radar 3. That and the tech stocks or the NASDAQ stocks look to be our best bet if we're thinking about buying anything, at least relative to the S&P. Now when we look at these sectors here, I quickly can see that with a score of 6, the retail department is doing better than the S&P in general. The consumer discretionary is also doing quite well, thank you. It's got a score of 6. And I see that the utilities has just stepped down to a score of -5. That's why it's white, and it's now all bearish. And this is a significant bit of information, because utilities sector is usually a flight to safety. So if you see the utilities sector strengthening, you might think that the market might be going down in general, because the utility sector is often seen as the last strong sector in the rotation of sectors. So it looks like utilities is getting weaker. So that's a good clue that we might not be seeing a complete reversal to the downside in the stock market right now. We see XLB, I believe, is materials sector is quite bearish. Of course, that's gold and silver and things that we know are bearish. And you can see here in this line here, gold is quite bearish relative to the SPY. So we don't see a flight to safety in gold in this case either. So nor oil, both are -3. The sectors are showing a strength in the consumer buying, retail and discretionary, and weakness in utilities and materials. So this is a sign of strength for the American indexes. Well, let's take a look at the futures contracts. The Russell daily chart here is showing us that the price is actually testing its previous highs at 1005 as shown by our support and resistance line tool here. So we are looking for a potential breakout to new highs, at least going to test that possibility. And there is significant buying strength still in the Radar 1 Fear Greed indicator. The caveat that I see is that the price leader, Radar 2, is currently extremely overbought and the fast line is heading back down. So we may not see an immediate test of this level or a successful breakout of this level. This is showing us that we're setting up for a trend exhaustion 1 overbought sell signal. Nonetheless, we are testing the high prices of early to mid-May in the Russell as compared to, let's take a look at the S&P. You can see on this chart that we're still significantly below here at 1629.25. That's about 2.98% below the highs of 16.79. So if it's going to keep going up, we're going to follow the Russell. However, on this chart I can see that the triple trender is bearish, and you can see we're setting up some bearish pullback divergences here in Radar 1 Fear Greed. I have my alert line on the Radar 1 set at this previous high here of looks like about 53.50. The most recent Fear Greed is 66.36. So we're making higher highs on the oscillator while making lower highs on the price. So that's indicative of a pullback divergence. Of course, this oscillator, the Radar 1 Fear Greed, has to roll over in order to complete that divergence. So it's not complete yet. However, we are up against this automatic trend line, this down trend line. So there is resistance at this level, and we could potentially see the S&P lead the markets down. Well, when we take a look at the 50,000 share chart, the analysis is a little more bullish. Note that although we've been going sideways for most of the last week or more, during the holiday break, the markets kind of broke out of that sideways range of 1619. Now they're up to 1628, testing the highs from a few days back, and they're testing them with significant buying strength relative to recent selling strength and relative to the buying and selling over the past several weeks. So Radar 3 is bullish, Radar 1 is bullish, Radar 2 is showing us a sell divergence. So we might see this start the week going down, considering we saw that we were at a trend line resistance on the daily chart. I wouldn't be surprised to see this particular test of this high fail, but it could succeed later in the week. Well, let's see if we can find a tradable stock for this type of market. Now, given the nature of the indexes that we just looked at, I'm going to be looking for something to buy and something to sell. And given the S&P 500 where it is right now, if it's going to go down, then I'm looking for a pullback divergence in the downtrend that we identified. And as we all know, one of my favorite pullback divergence setups is a trend exhaustion 1, 2, 3, which is a combination of pullback 23 and trend exhaustion 1. So if I take this TradeStation radar screen with the S&P 500 applied, and my Scan Sentry toolkit here. I can sort on bars ago, pullback 23, look for a short pullback 23 that happened about the same time as a short trend exhaustion 1 signal. And you can see we get one AIV and one with HCP. If we click on AIV, let's see what kind of chart comes up. Alright, you can see the AIV chart has come up, and sure enough we found a nice pullback divergence. You can see the auto div identified a trend divergence, which is a pullback divergence here, and we have the pullback 23 and the overbought 1 signal all happening here on the apartment investment and management stock. So everything's looking bearish, more or less. Triple trender's a little bit bullish, but we're going to trade this pullback divergence to the downside. Now let's see if we can find something to trade to the upside. We've been talking around the office a lot lately about the deep dip double and deep dip triple divergence setups, and here we have those on the radar screen. Now, the deep dip triple is also known as the sweet pea setup. So let's see if I can find something that might be a bullish trading opportunity. Well, here I see PFE has a deep dip double and a deep dip triple, both on the most recent bar. So let's take a look at that and see if that looks like a tradable opportunity. Okay, here's PFE, and the chart shows us, yes, we have a sweet pea divergence and a deep dip double, both here on the most recent bar that was testing the uptrend line. So it looks like we found resistance, and we have divergences giving us buy opportunities or buy signals at this relatively low price. So using our sweet pea deep dip double and deep dip triple, I'm going to be interested in finding a buy opportunity in Pfizer Incorporated, and I'm going to be looking for a sell opportunity in AIV. I want to thank you for taking a little bit of your time to watch this short video. I hope you found something useful in it. I do want to remind you that Jan Arps Trader's Toolbox is not an investment advisory service, and all of the examples we showed today are for purely educational purposes. We are not recommending that you buy nor sell anything, and just want to remind you that trading can be very hazardous to your financial accounts. But with good technical analysis tools and good technical analysis from those tools, you have a much better chance of not only surviving but profiting in these wild and crazy markets that we like to trade. So, without further ado, may the trend be with you.